All right, let's take a look at your chapter 13 homework on this problem number 1. We're going to be looking at the different sections of the classified income statement. So what they do in this problem is they give you a list of accounts 1 through 15, and they simply want you to identify what section of the classified income statement that they would go to. And so let me get that on. So first one, purchases, returns, and allowances. They're going to put that under cost of goods sold because it's going to be part of your inventory calculation. Telephone expense, you're going to put that under operating. Your sales, returns, and allowances, that's part of your operating revenue. Remember, it's that contra revenue account. Purchases, just like purchases, returns, and allowances, is under cost of goods sold. Interest income, because usually that's non-operating, is considered other income. Merchandise inventory, again, part of like purchases, is part of cost of goods sold. Interest expense is just like interest income. You're going to put that under other expenses. Sales is your operating revenue. Depreciation expense, this one says store equipment, so that's going to be operating expense. Then you've got rent, that's going to be operating expense. Sales discounts is operating revenue. Supplies expense is going to be operating expenses. And then we got freight in, which is part of inventory, which of course is cost of goods sold. Purchase discounts, again, just like the other purchases, is also cost of goods sold. And then finally, your uncollectible accounts expense, which would be an operating expense. All righty, so that is number 1. Let's check out the second problem. And on this one, we're going to be looking at accounts that are on the classified balance sheet. So first one, accounts receivable, they're going to call that a current asset because you expect to convert it within 1 year. Truck's going to be a long-term asset, so they're going to call that plant and equipment. Prepaid rent, generally short-term, so that's a current asset. Note payable, they're going to put this one under long-term liability because it says due sometime in 05. It's more than a year. Office supplies is usually a current asset. Accounts payable, current liability. Inventory, you do expect to sell that within a year, so that's a current asset. Capital is equity. Cash, of course, is a current asset. Unearned revenue generally should be a current liability unless they told you somewhere in the problem where you can't earn it within a year, but generally that's going to be a current liability. Notes receivable due within a year. Notice that's 02, that's 2, and this is a 1, so that's going to be a current asset. Accumulated depreciation, since it's associated with the truck, it's going to be plant and equipment, that's long term. Note payable due 200x2, that's within a year, that's a current liability. Drawing is part of equity. And finally, interest payable generally is a current liability. All righty. So that'll be problem number 2. Let's check out number 3. And in number 3, they simply just want you to put together a classified income statement. And you'll notice I'm just going to, here's all the accounts, and then hopefully you can follow this through. I'm just going to highlight some of the main items. Notice that you've got your sales, subtract out returns, get your net sales. And then the next section, they call it your cost of goods sold. All these is a calculation to figure out your cost of goods sold. So you're going to plug in all of your purchases, beginning inventory, and eventually you're going to figure out that your cost of goods sold is 112,225. So I like to think of this cost of goods sold as what they call a major line item. So plug these in, go back and review that formula on inventory. So cost of goods sold gets subtracted from net sales. There's your gross profit. And then everything below this, let me page it down, it's a pretty long one. Everything below cost of goods sold, notice you got your operating expenses. So they just start with selling. You just list all your expenses, total selling, and then you got your admin expenses. You list those, and then you come up with the total, subtract that from your gross profit, get income from operations, and then you have those other incomes like the interest and miscellaneous. You got to put those over here. And then finally, it looks like your net income should be 52,025. So try this one out. It'll take a little bit of time, but it's a good one to do. So this will be your classified income statement. All right, let's check this one out. This is number 4. And on this one, they want you to do your equity statement. I believe this one's just your equity statement. And on this one, remember your equity statement really hasn't changed all semester. You take your beginning capital. Notice here's your net income. This is the same net income from the previous problem. You subtract out withdrawals, and then you're of course going to update your capital. So this one should actually be a review one. And of course, here's that income statement from the previous problem. That's where they get the net income. So there's your equity. Let's check out number 5. And of course, the theme is we got the same problem here. Here's your balance sheet. Of course, they're going to go ahead and list your equity. Remember, your balance sheet is generally your financial statement number 3. And so remember how when you updated equity on the previous problem, that 80,085, that's going to go up here under the capital balance on your balance sheet. So scroll back up and look at this. We got the current asset section. So just kind of list all the different items that are in your current assets. Notice you subtract out allowance for doubtful accounts from accounts receivable. You got inventory prepaids, total current asset categories right there. Then you got your long-term assets, what they call plant and equipment. Notice you subtract out accumulated depreciation. That's a contra asset. You get your total plant and equipment, you add that, plus your current assets, you get your total assets. And then same thing, let me go down below. You have to plug in your current liabilities. You've got 4 of them in this case. And then there's no long-term liabilities. And then of course, we already got the capital. And then of course, your total assets should equal your total liabilities and equity. All right, that is number 5. Let's check out number 6. So now we're going to be looking at some ratios. On the first one, first of all, they want you to calculate gross profit. So here again is your calculation. This is just like your classified income statement. You got to get the net sales, subtract out cost of goods sold to get your 193,560. That would be your gross profit. The gross profit percentage is when you take your gross profit and you're going to divide that by your net sales. So if gross profit is 193,560, divide that by your net sales. That's going to be about 35%. That's where they're going to get this one right here. 35.7 is what they want you to plug in. Let's check out the next one. Is they want the working capital. Working capital is simply where you just compare current assets to current liabilities. Notice they're just showing you the formula right here, current assets minus current liabilities. Go back and find your current assets, subtract out your current liabilities, you get your working capital. And of course, down below, if you're wondering what are my current assets, they list them right here. And of course, here's your current liabilities. So that would be part B. Let's check out part C. Now with the current ratio, you divide instead of subtract. So you take the same 2 numbers with your current assets and your current liabilities, but you divide, and you're going to get about 2.47. Part D, we're looking at your inventory turnover. And on this one, you need cost of goods sold divided by your average inventory. Let me show you this one. Let me go down. I'll just show you the calculation. Check this out. Remember, with average inventory, you have to take, excuse me, the beginning and ending inventories and divide by 2. So that'll be your denominator. And of course, cost of goods sold is your numerator, and you're going to get 7.4. All right, next one is your AR turnover. You got to take your net credit sales and again divide by average receivables. And on that one, just like average inventory, you've got to divide your receivables by 2. So you take your beginning receivable plus an ending divided by 2. That's going to be your denominator. And of course, your net credit sales is the numerator. That's going to be your AR turnover. And I think that's the last one on problem 6. Let's check out number 7. We're going to do some of the same ones here. You got AR turnover, average collection period. That's just when you take 365 and divide by your AR turnover. And for inventory turnover, the same thing. You'll take 365, divide by that to get letter D. So it's the same calculations, except they're adding the time period in there. So again, on the first one, again, they take net sales, divide by average receivables. And again, remember on your average receivables, you have to divide by 2. So on this one, I'll show you this here. They give you the AR at the beginning and AR at the end of the year. And down here, though, this is basically them showing you the calculation on that one. And then, of course, once you get that, you just take 365 and divide by that AR turnover, and the average collection period is about every 45.63 days. Now we do the inventory turnover. So again, it's going to be cost of goods sold divided by your average inventory. And let me show you that again down below. And here it is. Cost of goods sold, average inventory. You divide those 2 to get your denominator. You get 8.5. And then the last one, you get the how many times you turn over your inventory. you just take 365, divide by that 8.5, and you're going to get 42.94. That'll be the last one. All right. So that is problem 7. And the last one, you have to go back, and it looks like they want you to do some more ratios and some line items here. So if you can notice, here's all the account information up above, and down below, requirement 1, to get to your net income, notice you got your 3 categories: net sales, cost of goods sold, gross profit, and then your operating expenses. Subtract those out, get net income, and then of course this one you had other income to get net income. Now the detail on that is right here on how to get those. Of course, we know how to get net sales, and then you remember you need to know your inventory calculation on how to get cost of goods sold, beginning inventory. You net your purchases, subtract out ending inventory to get your cost of goods sold, and of course we know the calculation on how to get to gross profit. And then of course we've got your operating expenses. List all your operating expenses, and then of course it's gross profit minus your operating expenses to get that income. And then on this one, it looks like they had other income and other expense. They netted those two to get that 800, and then finally you added that to get the net income for the year. So it's kind of strange on this one how they have you piece it together, but that's how you get these individual numbers. As you can see right here, here's your income statement. Just like the previous one. Alrighty. Okay, 3A, here's your gross profit percentage. Remember, gross profit, you're just going to take your gross profit, divide by your net sales, and you get about 77.4%. And again, they show you that calculation. I guess they don't on this one right there. I just showed it to you. All right. And then finally, letter B, the inventory turnover. Again, cost of goods sold divided by average inventory. They do show you that one down here, at least how you got the ending inventory. It's 21,000. And so if you're wondering where they got that, that's what it is. That's your denominator, and they get it right at 2.3. Okay, guys, that is your chapter 13 homework.